Let's begin with the foundation of business law by looking at sole proprietorships. This is the simplest form of business and serves as a great starting point for understanding key concepts like ownership, liability, and legal risk. A sole proprietorship involves just one owner who operates the business under their own legal identity, meaning that the owner and the business are legally considered the same. Because of this, the owner assumes full responsibility for any debts or legal issues the business might face. This straightforward structure makes it easier to grasp the essentials of business law and the responsibilities that come with owning a business. It's especially relevant for many small businesses in practice today. Here we're focusing on the fundamental concept of a sole proprietorship. Simply put, it's a business that is both owned and run by just one person. This means that there's no legal distinction between the owner and the business itself. In other words, whatever happens to the business directly affects the owner, and vice versa. Understanding this is crucial because it highlights the personal responsibility involved in this type of business structure. The owner has complete control but also bears all the risks. This core idea sets the stage for understanding how different business organizations operate legally. Here we see some important statistics about sole proprietorships in the United States. First, there are over 28 million sole proprietorship tax returns filed each year, which shows just how common this business structure is. In fact, about 80% of U.S. firms operate without any employees, meaning they are often run by just one person. Typically, a sole proprietorship has a single owner, and this usually means the business and the owner are treated as one legal entity. It's important to note that these figures are approximate and can vary depending on census and IRS reporting, but they clearly highlight the prevalence and nature of sole proprietorships in the business landscape. When we talk about the legal structure and formation of a sole proprietorship, it's important to understand that this type of business usually comes into existence through the owner's actions, rather than through filing formal documents. It typically starts with one person deciding to operate a business for profit. That's step one, simply having the idea and the intention. Next, the business begins functioning through sales, providing services, or entering into contracts. This is step two, where the business actually starts to operate and generate activity. Even though there isn't a formal registration process, like with corporations, this business activity itself gives the sole proprietorship a practical existence. Step 3 involves complying with local regulations. Depending on where you are, you might need certain licenses, permits, or to file a trade name to ensure you're operating legally within your community. Finally, Step 4 highlights that the business and the owner are legally one and the same. Unlike a corporation or LLC, there's no separate legal entity created here. The owner assumes all responsibility and liability directly. So, in summary, a sole proprietorship is formed by action, not by charter or formal filings, which makes it a straightforward way to start a business, but comes with unique legal implications. Here we're focusing on the concept of identity in law for sole proprietorships. The core rule is that the business and the owner are legally the same entity. This means that all rights, debts, contracts, and liabilities belong directly to the individual owner. There is no legal separation between the business and the person running it. As a result, the owner's personal assets remain exposed to any business liabilities or debts. This is a crucial point to understand because it affects how risks and responsibilities are managed in this type of business structure. Here, we're focusing on the concept of unlimited personal liability. This is a critical legal risk because it means there's no separation or liability shield between you as the owner and your business. In practical terms, if your business faces lawsuits or debt it can't pay, your personal assets, like your savings, wages, and property, are all at risk. Essentially, business debts can extend beyond the company itself and reach into your personal financial life. This is a serious consideration for any business owner, emphasizing the importance of understanding the legal implications of your business structure. Let's talk about liability in a sole proprietorship. The key idea here is that the owner's personal assets are on the line, not just the business itself. For instance, In our first scenario, if a customer slips on a wet floor without a warning sign and gets seriously injured, the owner could be personally responsible for all medical bills, damages, and any legal costs that arise. In the second scenario, if the business can't pay its debts, say, after a slow season, the creditors don't just go after the business, they can come after the owner's personal finances directly. And in the third case, if an employee, like a delivery driver, causes property damage while working, the owner might also be held personally accountable based on agency laws. The bottom line is there is no liability shield here. The owner and the business are legally one and the same, which means personal and business risks are fully intertwined. Let's talk about the tax treatment of sole proprietorships, which is a key concept in business law. In a sole proprietorship, the business and the owner are essentially the same for tax purposes. This means that all the income generated by the business flows directly to the owner, without the business being taxed separately. One of the core tax characteristics of sole proprietorships is that they are pass-through entities. This means that profits and losses don't get taxed at the business level, but are instead reported on the owner's personal tax return. Typically, the business income and expenses are reported on Schedule C, which is attached to the owner's Form 1040. It's important to note that in addition to ordinary income tax, the owner may be subject to self-employment tax. This covers Social Security and Medicare obligations on net earnings from the business. To give you a clearer picture, here's a simplified comparison with other business structures. Sole proprietorships do not pay entity-level tax. All income is reported directly on the owner's return. Partnerships or LLCs usually have pass-through taxation as well, with owners reporting income allocated via a K-1 form. Corporations often pay taxes at the entity level, and owners can be taxed again on distributions, creating a separate layer of taxation. In summary, sole proprietorships offer tax simplicity since the business income is reported on the individual's return, but this also means personal exposure to self-employment taxes. Understanding these distinctions helps in choosing the right business structure for tax purposes. When it comes to ease of setup and regulatory burden, one of the main advantages of a sole proprietorship is how simple it is to start. Typically, there are few filings required, which keeps costs low and allows for a fast start. Many sole proprietorships actually begin operating without any formal state formation documents, making the process very straightforward. However, it's important to keep in mind that while formation is minimal, often just some basic registration, this doesn't mean you're exempt from all legal responsibilities. Licenses, permits, and local regulations still need to be addressed to stay compliant. So, minimal formation requirements don't translate to zero compliance obligations, which is a key point to remember. Overall, the simplicity here makes sole proprietorships very accessible, especially for those just starting out. When we look at different types of business organizations, it's important to understand how a sole proprietorship stands apart from the others. Starting with liability, a sole proprietorship has unlimited liability, meaning the owner is personally responsible for all business debts. Partnerships also usually have unlimited liability, though this can vary depending on the type of partnership. Limited liability companies, or LLCs, and corporations offer limited liability protection, shielding personal assets from business debts. In terms of taxation, sole proprietorships and partnerships benefit from pass-through taxation, so the business income is reported on the owner's personal tax returns. LLCs usually enjoy pass-through taxation as well, but they also have the option for entity-level taxation. Corporations can be taxed as separate entities, which sometimes can lead to double taxation. But there are also S-corp options that allow pass-through taxation. Formation requirements differ as well. A sole proprietorship is automatically formed when you start doing business, with no formal filing needed. Partnerships require an agreement between parties, which may be informal or formal. LLCs and corporations, in contrast, both require state filings to be officially recognized. Ownership structures vary. A sole proprietorship has a single owner. Partnerships require 2 or more owners. LLCs can have 1 or more members, and corporations have shareholders. Lastly, when it comes to continuity, a sole proprietorship ends with the owner's death or decision to close the business. Partnerships depend on the terms of the partnership agreement. LLCs tend to be more durable, able to continue despite changes in membership, while corporations are the most durable, often existing indefinitely unless legally dissolved. So, while these business forms may share the same fundamental goal of operating a successful business, their legal and financial consequences are quite different, making it crucial to choose the right structure for your specific needs. When we look at capital and financing challenges for a sole proprietorship, there are a few key points to keep in mind. First, while starting a sole proprietorship is relatively easy, scaling it financially can be quite difficult. One major hurdle is the reliance on the owner's personal credit. Since the business doesn't have a separate legal identity, funding typically depends on the owner's personal credit score, assets, and guarantees. This can limit how much capital is accessible. Secondly, attracting outside investors is often a challenge because there are no shares or stock to sell. This means equity investment from external parties is far less practical compared to other business structures. Thirdly, borrowing capacity is limited. Lenders often perceive sole proprietorships as riskier because the business is not a separate legal entity, making it harder to secure loans. In essence, the core constraint here is that the business's growth potential is closely tied to the owner's personal financial strength. Without substantial personal resources or credit, expanding the business can be a major challenge. When we talk about compliance in practice, it's important to understand that licensing, permits, and regulatory requirements are not one size fits all. These requirements vary greatly depending on the local area, the specific industry, and the nature of the business. For example, even though starting a sole proprietorship might be straightforward, the compliance obligations will differ based on what kind of business you have, where you're located, and which regulatory bodies govern that sector. Industries like health, food service, trades, and finance each have their own set of licensing rules that need to be followed closely. Location matters too. You have to consider regulations at multiple levels: city, county, state, and even federal. Compliance isn't a one-time task either. Registering your business is just the beginning. You must stay on top of renewals, inspections, and regular filings to remain compliant. Failing to adhere to these rules can lead to serious consequences, including fines, orders to shut down, or losing the legal authority to operate. So staying informed and proactive about compliance is essential for any business to thrive. Let's talk about intellectual property and how it relates to sole proprietors. Even if you don't have a separate business entity, you can still own and enforce important intellectual property rights. First, trademarks protect your business's names, logos, and overall brand identity. These rights come into play as soon as you start using your trademark in commerce. But registering it can give you stronger legal protections and make enforcement easier if someone else tries to copy you. Next, copyright protects original works once they are fixed in a tangible form. This includes your website content, photographs, writings, and marketing materials. While these protections come automatically when you create the work, registering your copyright provides additional legal benefits. Then, there's trade secrets, which safeguard confidential business information, like customer lists, formulas, or unique business methods. The key here is that these remain protected only so long as you keep them secret. So, the main takeaway is that protecting your intellectual property depends on how you use it, whether you register it, and how well you maintain its confidentiality. Managing these factors carefully can really help safeguard your business's unique assets. When we talk about continuity and succession in business, especially in the case of a sole proprietorship, the key idea is that the business is inseparable from its owner. Unlike other business structures, a sole proprietorship has no legal existence separate from the owner. This means that when the owner leaves, whether due to death, incapacity, or simply deciding to step away, the business typically ends as well. This creates significant challenges. For example, contracts, licenses, and accounts often must be re-established by heirs or a buyer because the business itself doesn't automatically continue. While the goodwill associated with the business might survive, the legal entity does not. This clearly highlights the importance of succession planning for sole proprietors. to ensure some level of continuity after their departure. In short, the enterprise is legally tied to one person, making the personal situation of the owner directly impact the fate of the business. Addressing this risk upfront can help mitigate disruptions and preserve the business legacy. When it comes to transferring a sole proprietorship, it's important to understand that you can sell the individual assets or contracts, but not the proprietor themselves. A sole proprietorship doesn't have a separate legal identity, so it can't be transferred as a whole entity like a corporation can. Instead, the assets, contracts, and any goodwill must be assigned one by one. Typically, a buyer will start a new business under new ownership rather than simply stepping into the shoes of the original proprietor. Legally, this means the transfer is considered a transaction involving property, not a transfer of the business entity itself. This distinction affects how the sale is structured and what legal steps need to be taken. When it comes to the law of business and business organizations, one of the most important principles is keeping personal and business finances separate. Just because you're the sole owner doesn't mean you should use only one account for everything. Mixing funds can blur the lines between personal and business money, making taxes, proof of income, and liability issues much more complicated. For example, if you pay rent from the same account that holds your business revenue or expenses, it becomes difficult to track what belongs where. Using separate accounts for your business income, expenses, and payroll, and for your personal living, savings, and household costs helps keep clear records. This separation creates cleaner accounting and strengthens your legal protections. In short, maintaining distinct personal and business banking is essential for managing finances effectively and ensuring proper legal discipline. It may take a little extra effort, but the clarity and protection it provides are well worth it. When it comes to the law of business and business organizations, one of the most critical aspects is proper record-keeping and accounting obligations. Good records don't eliminate liability, but they do make it much easier to prove, manage, and defend your financial position. First, it's essential to consistently track all income and expenses. This helps you maintain a clear picture of your business's financial health. Second, always keep receipts, invoices, and bank records organized and accessible. These documents are crucial when it comes to verifying transactions and supporting your financial statements. Third, you should separate personal and business transactions entirely. Mixing the two can cause confusion and may raise red flags during audits. Fourth, maintain all records diligently for tax reporting and potential audits, as the government expects accurate and thorough documentation. Finally, using basic bookkeeping systems and reconciling your accounts regularly ensures accuracy and helps catch any discrepancies early. Overall, good documentation supports compliance and strengthens your ability to handle financial responsibilities confidently. A sole proprietorship makes the most sense when you're running a lean and personal business that carries low risk. This structure is perfect if you prioritize simplicity over the legal separation between you and your business. It works best under ideal conditions where there's low liability risk, operations are straightforward, and your business is largely driven by your personal brand. You'll often see this setup with freelancers, consultants, and solo service providers, where the business is owner-operated and closely tied to the individual behind it. A sole proprietorship is simple and works well when you're operating on a small scale with limited risks. However, there are clear limits to when this structure makes sense. First, if your business involves high-risk activities, like the potential for lawsuits or major contract liabilities, the unlimited personal liability can put you in serious danger. Second, if you have significant personal assets such as your home, savings, or investments, these may be at risk if your business incurs debts or legal judgments. Third, as your business grows and you seek outside capital or investors, you need a more formal structure that legally separates you from the business. A sole proprietorship doesn't offer that separation. Fourth, once you introduce multiple owners, a sole proprietorship no longer reflects the legal reality because it's designed for a single owner. Finally, if your business must continue beyond your involvement, whether due to death, exit, or incapacity, the sole proprietorship form is too fragile to ensure continuity. These limitations make it clear why many choose different business structures as their needs evolve. When it comes to legal remedies and protections for a sole proprietor, it's important to understand that while you can't completely eliminate your exposure, you can certainly narrow it down. One of the first layers of protection is insurance. Having the right coverage, such as general liability, professional liability, property insurance, and workers' compensation, helps absorb losses before they impact your personal assets, is a crucial safety net. Written contracts play a vital role, clearly defining terms related to the scope of work, payment, disclaimers, indemnity, and dispute resolution helps set expectations up front and reduces the likelihood of conflicts later on. A solid contract is your first line of defense in legal matters. Finally, operational safeguards are essential. Keeping business and personal accounts separate, maintaining meticulous records, adhering to licensing requirements, properly training your staff, and documenting any incidents all contribute to a stronger legal stance if issues arise. The practical takeaway here is that true protection stems from layered risk management strategies rather than just relying on the form your business takes. It's about combining insurance, contracts, and sound operations to create a comprehensive shield against potential risks. As a business grows, the legal approach often shifts from simplicity to separation. This is the law of business and business organizations at work. The core legal aim here is to move the business from being tied directly to the owner into a distinct legal entity. In stage 1, growth brings greater exposure. With more contracts, employees, debt, or customers, personal liability becomes a bigger risk that's harder to accept. This is why many businesses consider changing their structure. Stage 2 involves choosing the right form, often an LLC or corporation. This choice depends on the need for liability protection, tax considerations, and future investment plans. Stage 3 requires forming the new entity. This means filing the appropriate state formation documents, getting tax registrations, and updating all necessary licenses and contracts. Finally, in stage 4, the business must be transferred into the new entity. All assets, operations, and obligations need to be properly moved so that the entity itself, not the individual owner, conducts the business. It's important to understand that this conversion is a form of legal restructuring, not just a simple name change. This process protects the owner while positioning the business for continued growth and success. When we talk about sole proprietorships, it's important to understand that while the basic structure remains the same, the legal risks and pressures vary significantly depending on the industry. For example, in the trade industry, the main concerns are job site injuries, equipment damage, and ensuring proper insurance coverage. In retail, businesses need to focus on managing sales tax, premises liability, and complying with consumer protection laws. For service-based businesses, the risks often revolve around licensing requirements, potential malpractice issues, and contract disputes. Lastly, in creative work, the primary concerns include copyright issues, client rights, and how intellectual property is used. So even though the ownership model is consistent, the specific legal and compliance challenges differ widely across industries, making it crucial to tailor risk management based on the sector you're operating in. Let's look at a plausible sole proprietor scenario that highlights a critical legal risk. A sole proprietorship is often praised for its simplicity, but that very simplicity can lead to significant personal exposure if something goes wrong. For example, imagine a self-employed contractor who does faulty electrical wiring, which then causes a fire. The homeowner sues the contractor for repair costs, lost rent, and negligence. Since the business and the owner are legally the same entity, any judgment from the lawsuit doesn't just affect the business. It can directly impact the owner's personal bank account and assets. The key takeaway here is that in a sole proprietorship, business debts and liabilities become personal liabilities. This risk is essential to understand, especially when deciding on the legal structure of a business. Without the protection of a separate legal entity, personal assets are fully exposed to business risks. let's look at some of the recent legal developments and trends that are shaping the landscape of business organizations. One key area to watch is how state and local licensing rules are expanding. These rules now often cover online, home-based, and platform-driven businesses, reflecting the changing ways people operate commercially. Next, tax updates are continuously evolving. They affect reporting requirements, deductions, and estimated payment obligations, especially for self-employed business owners. Staying informed here is critical to avoid penalties and optimize tax positions. Privacy and consumer protection laws have also broadened their scope. Sole proprietors who collect customer data now face more extensive duties, which means they must be diligent in how they handle and protect personal information. Finally, courts are paying close attention to issues such as misclassification of workers, fraud, and informal record keeping. These factors can heavily influence the outcome of legal disputes when they go to litigation. Overall, these trends highlight the importance of compliance and careful management in today's business environment. Now, let's look at some essential resources for sole proprietors to help navigate compliance, tax reporting, and legal matters more effectively. First, government resources like the SBA, IRS, and various state agencies provide crucial guidance on business formation, tax forms, and licensing requirements, which are foundational for staying compliant. Then, for legal references, sites such as the Secretary of State and Cornell's Legal Information Institute offer clear access to business filings, statutes, and easy-to-understand legal definitions to help you grasp the rules and regulations that apply to your business. On the accounting side, tools like QuickBooks and Wave can be invaluable. They simplify bookkeeping, invoicing, expense tracking, and can help you stay prepared for tax season, making your financial management much smoother. Finally, recommended reading materials like NOLO Guides and the SBA Learning Center cover key topics such as contracts, liability, taxes, and basic operations. These resources provide practical knowledge to help you make better day-to-day decisions and lay a solid foundation for your business success. To wrap up, let's focus on the key takeaways about the sole proprietorship. It's incredibly easy to start because it's not a separate legal entity. It's essentially the owner and the business as one. This means the owner keeps all the profits, but also shoulders all the risks. The liability is personal, direct, and unlimited, which can have serious consequences if things go wrong. Taxes are straightforward, since they pass directly through to the owner's personal tax return. Sole proprietorships are perfect for simplicity, but tend to be weak when it comes to growth, continuity, and legal protection. In short, while forming one is simple, the consequences of operating without legal separation are significant and should be carefully considered.